Hi traders, you're welcome back to the Forex Geek channel. Now in this video, we are just going to be breaking down the top 5 Forex trading strategies that actually work. Okay, each strategy is simple to understand, it's easy to implement, and can be adapted to different market conditions. So by the end of this video, you have a clear blueprint that you can start practicing immediately. Okay, let us start with the trend following strategy. This method is all about trading in the direction of the dominant market trend. All right. You can identify a trend using a 50 period and 200 period moving average. All right. So, yes, the moving average indicator is one of the most commonly used indicators. All right, so we're going to be using the 50 period moving average and the 200 period moving average. Okay, so basically when the 50 period moving average is above uh the 200 period moving average, you should be looking for buy opportunities. All right, and when the 50 period moving average is below the 200 period moving average, you should be looking for sell opportunities. Okay, you might want to combine this with higher highs, and higher lows. That's for an uptrend. So basically, when you find a bullish structure, all right, when you have the 50 EMA cross above the 200 EMA, and at the same time you have a bullish structure of higher highs and higher lows, that even supports your bullish bias. All right, and then in a downtrend, when you find the 50 EMA cross below the 200 EMA and you're also having lower highs and lower lows, that supports your bearish bias. Okay, the key is to ride the trend until there is a clear sign of reversal. Okay, so this is very easy to use. Now, the second strategy that we are going to be looking at is the breakout trading. All right, the next is the breakout strategy. This works best after price has been consolidating in a tight range. Okay, so now let us look for a consolidating period, and then right after that consolidation, there is usually a breakout that follows. Whenever you have a consolidation, always expect a breakout. Okay, always expect a breakout. So this works best after price has been consolidating in a tight range. Then you, of course, you have to draw your support and resistance levels, and you wait for a strong candle to break through. Okay, as you can see in this particular context, you can see this particular candle broke through this range. If you look at the candle closely, you can see the momentum. You can see how strong this candle was, showing that the bears had taken control. Volume confirmation also helps to filter out false breakouts. Okay, the idea is to enter right after the breakout and you ride the momentum before it fades. So whenever you have an increase in volume when a breakout occurs, there is a likelihood of that breakout being valid. Okay, then once you enter, your stop loss should be within the range. Okay, do not just set your stop loss at the breakout point. You need to set it inside the range. All right, and then your target profits can be at maybe key levels. Maybe you can just target, if it's a bearish breakout, you can just target a support zone. Just reference a previous low and target that for your take profit. All right, so in that case, if we had entered a sell around here, perhaps our stop loss would have been above that immediate, you know, um, candle that spiked within the range, or rather that immediate minor high, within the range, and then your target profits can be around the next support level. But that is for a bearish breakout. You just want to catch the impulsive move and then you are out of the market. Okay, so you might not necessarily have a very large risk to reward ratio, but at least you should have something reasonable. Okay, now the next strategy that we are going to be looking at is the range trading. All right, we have the range trading. This strategy thrives in sideways market. Okay, so basically, when you have a sideways market, that's when you're going to benefit from the range trading. Okay, um, I'm going to mark out this range. All right, so this occurs, when price is bouncing between support and resistance. You identify the range boundaries. You can just use a rectangle to, identify the range boundaries, or better still, you can just, use your horizontal line and just mark out perhaps the first two, rejections. The first two rejections. Yeah, it's true that sometimes you might have a false breakout, like what happened here. You can see that this was a false breakout, but then eventually we had a legit breakout here. But just mark out the first two rejections on the downside, the first two rejections on the upside. That gives you your resistance and your support. So what you want to do is, after identifying the range boundaries, you buy at the support and you sell at the resistance. Always use stop losses just outside the range in case of a breakout. Now, we are just going to be honest. Had it been you had bought here, probably you would have gotten stopped out due to this false breakout. Okay, but if you had bought here, you would have made some gains. If you had sold here, you would have made some gains. If you had bought here, you would have made some gains. If you had bought here, you would have made some gains. If you had sold here, you would have made some gains. But if you had bought here, you would have gotten stopped out, right? And then if you had bought here, you'd have gotten stopped. So that's the reason why you need to always prepare for the breakout, because at some point that breakout will happen. So just prepare for it. Okay. Now, the fourth strategy we're going to be looking at is the pullback strategy. In trending markets, price often retraces before continuing in the same direction. And as you might have heard the saying, that price does not move in a straight line. There are always zigzags, right? So you can actually use tools like the Fibonacci retracement. This is one of the common tools that traders use, or you can even use moving averages to find areas where the pullback might end. Okay, you just want to enter when you see a confirmation. If it's an uptrend, you look for bullish confirmation. If it's in a downtrend, you look for bearish confirmation. Okay, this gives you better entries and reduces the risk compared to chasing the trend. Now, finally, we are going to be talking about divergence trading. Okay, this involves comparing price movement with an indicator like the RSI or the MACD. Okay, you can decide to use the RSI or the MACD for this divergence trading. Okay, so for example, if price is making higher highs, but maybe the RSI is making lower highs. If price makes higher highs, but your RSI makes lower high, that shows, a bearish divergence. It could signal that a bearish reversal is about to happen. Okay, on the other hand, if price makes lower lows, but maybe the RSI makes higher lows, that shows that bullish reversal is probably about to happen. Okay, and that is a bullish divergence. So, in a situation where price makes lower lows and your indicator makes higher lows, it shows that a bullish reversal could be imminent. Okay, this strategy is particularly useful for catching early trend changes. Now, whichever strategy you choose, risk management is critical. Never risk more than 1 to 2% of your account per trade. Always use stop losses, avoid over trading. Remember, no strategy works 100% of the time, but with discipline and consistency, you can achieve steady results. So these top 5 Forex trading strategies that actually work are proven approaches you can adapt to your own style. Practice them in a demo account before trading live. If you found this breakdown useful, hit the like button and subscribe so you don't miss more powerful trading strategies and tips. Okay, thank you for watching, and I look forward to seeing you in the next video. Happy trading.